Hello, everyone. Thanks for joining us today. We have a special webinar presentation for you. It's an advantage for Management One to have a lot of experts in various fields outside of retail. And today we're joining forces with our friends at Telemus to speak more about the financial landscape. So we're going to be assessing the economic landscape for independent retailers in Q4 and beyond. Before we get to a lot of the questions that we're going to be throwing out there today, I did want to go through a couple of house rules. The first one being obviously audio. We want to make sure that you can hear us crystal clear. So the GoToWebinar platform does offer a couple of options, computer or phone. So please choose whichever works best for you. Secondly, most importantly, this is an open panel discussion. Towards the end, we're going to open it up to live questions. So please use the questions platform in GoToWebinar, and we'll answer those in the order that they're given. Finally, the most important thing for you, the question that we get most often, will we be sending out a recording? We absolutely will. So there will be a recording sent out if you need to leave early for any reason. So without further ado, I will be turning this over to Mike Alec, President of Management One.
Excellent. Well, thank you, Nico. Thanks, Nico. Thanks to all of you who are joining us today. Appreciate your taking time out of your day. Thanks to our panelists, Matt Demetriuson of Telemus, Jared France of the Capital Group. I hope you'll all find this interesting. A little bit about Management One for those of you who don't know us. We exist in order to help provide financial security for our clients who are primarily independent retailers, of course, our employees, and our network of affiliated experts around the world. We do that by providing merchandise intelligence and education for independent retailers. What that means in practice is a combination of software, data analysis, and advisory service focused around inventory management and the buying process. And we try to do all of these things, deliver our services with the values you see on the right: a generous heart, courage, curiosity, adaptability, commitment, and collaboration. We try to live up to those every day. And this year we've made a specific focus on trying to become a more diverse company and support diversity and inclusion in American society as a whole. With that as an intro to Management One, I will turn it over to Matt Demetriuson to let him introduce himself and Telemus.
Thanks, Mike. And again, I'm Matt Demetriuson. I'm the Director of Investments at Telemus. Telemus is a registered investment advisor. We're based out of Southfield, Michigan, with offices in Ann Arbor and Chicago as well. We manage a little over $3 billion in assets for wealthy individuals, families, and foundations. And part of my role on the investment team is we have the opportunity, given kind of our size and our network, to partner with large institutional investment firms similar to Capital Group, where we can kind of get their insights and perspectives across asset classes, bonds, stocks, real estate, and the like, as well as we do direct investments ourselves. And so we kind of get a boots on the ground feel. So hopefully with that backdrop, I can add a little bit to the discussion today. Like I said, we have the opportunity to partner with big firms, and Capital Group being one of them, one of the largest institutional asset managers in the world. And we're privileged to have Jared France, who's one of the economists on the economics team at Capital Group. So Jared, I'll hand it to you to introduce your background.
Great, appreciate that. Yeah, so I'm an economist at Capital Group. Just to give folks a really quick background, I'm on a team at Capital Group that incorporates not just the economists, but also political scientists and forensic accountants. So there's about a dozen of us globally around the world here, where we cover different countries. I cover the US, a little bit of Latin America. And I'm on the equity side at Capital Group, and so I primarily help our equity investors with the economic outlook. That said, I used to be at T. Rowe Price, where I was on the fixed income side, and so I'm very familiar with the fixed income side of the business, and also contribute to that as well here at Capital. So I can get into, do you want me to get into some of the outlook thoughts, or do you want to go to Q&A, or how do you want to work this.
Yeah, well, why don't we just, so we'll get to the outlook thoughts in a minute. I just wanted to sort of kick it off actually with something that's, I think sort of become top of mind with the news this past week about the government. So before we dive into the sort of recession and how we recover, we just sort of quickly get your perspective, maybe Jared, on what's your perspective on what's going in Washington? You know, the first round of stimulus is in response to the coronavirus-induced recession. For all of its flaws, does seem to have helped the Paycheck Protection Program, the extended unemployment, the sort of government payouts to households. Are we going to get another round? And if so, any sense about when and what that might be?
Yeah, so that's a tough question because what's happened over the weekend with the Supreme Court vacancy might actually cloud or make it more difficult to get another round, which was already looking pretty bleak because Democrats and Republicans had disagreed on the composition of that package. So I totally agree with you. As we go back to kind of April and March, it was pretty clear that the economy was going into recession. We got a big package, $3 trillion-ish altogether, with all the sub packages also added to that. Got another $3 trillion from monetary policy, and we got the moratorium on evictions and pretty broad-based support. And if you look kind of at the consumer has been really insulated from a lot of the worst part of this pandemic, aside from the actual getting the pandemic or getting the disease, but from an economic point of view, have been relatively insulated with unemployment benefits and things like that. So we're now in a period that's kind of similar to where we were in March, where we don't know where the pandemic is going because we've kind of come down to this 40,000 cases per day level, and we're kind of ticking up more recently. So we haven't totally killed the virus. At the same time, we've kind of exhausted our fiscal policy bullets, and we don't have another package that's ready to go. And so we're really in this kind of question mark period where all those effects that the consumer has been relatively insulated from could start being more impacted now that we head into September and October and into the election if this Supreme Court vacancy really makes the water more toxic. So I'm worried. I guess I'm more worried on Monday than I was on Friday that the limited kind of hope that I had that we'd get a fiscal package between now and the election just became even more difficult.
Yeah. Matt, any thoughts on this topic of Washington from Telemus's perspective?
No, I think we would agree with Jared. I think it's becoming less and less likely that a deal comes through before the election in a more polarized Washington.
Yeah. Well, okay, so that's obviously the election season is going to slide right into the holiday season, which is obviously a really big deal for all of our retail clients and for retailers across the country. So let's talk a little bit before we go broader based on where the economy is going about what you guys see for how the holiday season is shaping up. Deloitte came out with their predictions. Don't know how they do them for 1% to 1.5% growth over last year. Some people are saying, I've seen some speculation, which seems reasonably logical, that people may spend more on objects, on things, and less on experiences, given the difficulty in air travel and restaurants and spas and things like that. But what's your perspective, Jared? What does Capital Group think about how holiday 2020 might look?
Yeah, I think it's partially linked to your first question, and to the extent that we had been insulated for the most part, and let's be frank here, this recession that we're in right now has been, for the most part, for white collar workers, been not bad. I'm sitting in my home office, kind of doing pretty much the same thing I was doing before, a little different location, but not feeling the severe impact. there are lots of folks at the lower and middle income spectrum of the economy that aren't doing well, and with the prospect of unemployment benefits getting cut and slowing outright, and without the prospect of another stimulus, we could be entering a holiday season where it's going to be more bifurcated, with folks at the higher end doing okay and buying things like last holiday season, so very little change. Like you pointed out, maybe not taking that trip to Cabo or wherever, for the winter, let's say for a skiing trip for the holidays. Maybe that doesn't get converted this year, but like you're saying, goods look like they're going to be still sustained. The other thing I just point out is that what I've read, at least, is that I always complain that the holidays are getting earlier and earlier, and you get to October and they're already having Christmas sales. But it looks like, from what I've read, at least, the retailers are pulling forward that season even earlier. People are at home and they can purchase things now, and I think in some respects, people are looking forward to the holiday season as being a pretty dismal year already, and just kind of maybe splurging a little bit at the end.
Okay, that makes sense. I think that this idea of a bifurcated between different classes of consumers, and maybe different classes of goods too within goods, right? There are certain kinds of goods that fancy suit that you used to wear to the office maybe is less on the holiday wish list, but outdoor equipment maybe more. Matt, what's your perspective on what?
Yeah, I'm a little less optimistic, I guess. I think because of what's going on, this is obviously a very impactful election, and there's very strong views on both sides of the aisle. And on top of that, I think if you look at a lot of the consumer spending numbers, the consumer is healthy, but the rate of change is starting to decelerate. And a key driver of that, obviously, is on the stimulus side. So those that were unemployed were getting $600 a week of additional unemployment benefits. That's now $300, and at the end of this month, that goes away. We also had a round of stimulus checks that were sent out, and there was, I think, some hope by some that you would get a second round of stimulus checks being sent out. And per Jared's earlier comments that I would agree with, it seems less and less likely. And so I could see the consumer going into the holiday season, especially as you get into November, being fairly cautious, just because we don't know what the political environment's going to be like. And if we don't know what the stimulus is going to be, and there's still the thought that we could, who knows if we hit another round of COVID cases. You're obviously seeing an uptick in the UK right now. And I could see consumers being a little more cautious. I think the challenge as an independent retailer is you may have that cautiousness, but if you were to get some sort of stimulus to pass shortly after the election, that could reignite consumers to be a little bit more optimistic and do some late shopping trends on that, or some late in the season shopping. So I think we could kind of see a little bit of that. The other piece is, to Jared's comment, if you are seeing a little bit of the substitution effect, if you're not making that trip to Disney World or to Cabo, and you're substituting it for other goods. And an interesting stat I saw a couple weeks ago was, if you look in the months of July and August, sporting goods and hobbies stores sales were up 30% year over year those 2 months. And so there's clearly less on travel and more towards those hobbies. And I think the outstanding question I have is there momentum to that? Is there sustainability to that? Or did you buy that new set of golf clubs and now you're good? And I'm not sure how that translates to the holiday season.
All right. Well, that's probably a good segue to our next question, which is sort of about the recovery, the economic recovery more broadly. Jared, what's your sense of how this recovery, and we're all, of course, assuming that there will be an economic recovery from the COVID effect, how will it compare to the recovery from the 2008 financial crisis and recession?
It feels, having lived through 2008 in the industry, in the financial industry, there's kind of a speed element of it, where in 2008, you kind of got to March and April and things were getting bad, but not really that bad. There's still a question mark that might be a shallow recession. And it was kind of the slow moving, prodding process. And you kind of went about your day job and went into the office, and it kind of felt like a normal recession until September, October. Obviously, it got much worse. But there was kind of time mentally, I guess, for me to prepare. And the biggest contrast for me is that, look, you got into March and things were happening so fast and violently, and almost on an hourly or even daily basis, with whether we're going to get policy support, whether we're going to get monetary, either fiscal or monetary. Remember at the very beginning, the ballpark of $8 billion as being the first round of stimulus. The quote was that we're not going to spend $8 billion willy-nilly, and now we're at $3 trillion, right? And so massive, very rapid changes early on. That's kind of one of the first things I kind of differentiate now between '08, and that's more maybe just from a practitioner's perspective. But the second important thing is that the rapidity of the policy response. Yes, it was probably a little bit lagged, and yes, we didn't have the experience of SARS back in early 2000s to kind of use as a template for reacting to the virus. But once policy did kind of the cavalry did come, it did come in scale, which is very different than '08. In '08, remember the ARRA, I remember it not getting passed and seeing the S&P fall, 10, 15%. That policy response has been in size and rapid. Ditto for the monetary policy response has been very quick, opening up I guess new facilities that hadn't existed in '08, but also kind of going to the bookshelf and looking at the old facilities that had been done. So that's been pretty rapid. But I guess the other just last point is just to say, the big difference is that, we went from an unemployment rate point of view, we went almost to 20% unemployment if you look at the unadjusted unemployment rates in February and March, and you're coming down to 10% unemployment, which is contrast that with '08, where you kind of steadily rose to 10% over kind of a plodding, let's say 6 to 12 month period, and then you kind of leveled off and came down. But as I kind of look forward to the recovery in this year and into 2021, I think there are, like '08, there are going to be industries like retail, travel, that have been hard impacted by COVID, that are going to be hard, and they're going to struggle to get back in terms of redeploying that labor back to the old model that had existed in February. So I do feel like, just like the mortgage brokers and construction workers that were underemployed in the recovery after the GFC, I think we're going to have this shadow unemployment that's going to persist longer than we expect in the years ahead.
Okay. Yep, that makes sense. That so that kind of said there's some classes of workers in particular who are going to find it harder to adjust because the economy is actually going to go through some changes that persist. Matt, what's your sense about the recovery?
I kind of agree with Jared. I think what's happened on Wall Street is not what's happening on Main Street. It's not a V-shaped recovery on the Main Street front, and I think there is going to be some lingering effects, just as Jared pointed out.
So what about this concept of a K-shaped recovery? I mean, people talk about the shape of the recovery. Is it a V? Is it a U? Is it an L? Is it a swoosh? Recently, I've read more about K-shaped recovery. What does that mean? And do you think that's likely what's going on? I'll throw that to Jared.
Yeah, I mean, I think, I kind of have sympathy for this. I mean, I honestly, I'm not a huge fan of the kind of recovery shape literature. And the only reason being is that I think what really matters is how far we are. I think what really matters is what the structure of the economy looks like in 2021 and 2022, and how the supply side reacts. So do we go in 2022, let's say, just kind of end to end, do we go back to a world where it's like February of 2019, the same number of kind of airline flights between New York and London, or do we go to something very, very different? And that really shapes this question of excess capacity that I think is I think, more important kind of structurally for the economy than kind of the letter shapes. But as I think of what resonates with me on the letter shapes more than anything is kind of going back to the earlier point is, look, this is a recession that has been very uneven for large portions of the economy. And you go back to where we were in 2018, 2019, this was a point 10 years after we started the recovery post GFC, the lower income cohorts in the United States were finally getting wage gains that were in excess of the higher income cohort. So it took that long and finally doing well on the wage front. It also took that long for balance sheets, if you kind of peel away the onion a little bit on what the balance sheets look like by income cohort. The upper income cohorts were deleveraging for most of the post-GFC period. It was a lower income cohort that really didn't start until 2017, 2018 to really start delevering. And so I think that kind of also kind of drives the broader question of where we are with the political dynamics and socially, is that there is still pain underneath the surface. The K-shape is kind of representing that, with higher income doing okay and lower income not doing well. And it's really going to shape not just the economic recovery for the next year or two, but I think it's going to also structurally shape kind of where our politics go for the next few years.
Yeah, well, that makes sense. All right, well, let's drill down a little bit more on retailers, who are our specific audience today, and the market that we focus on and the customers we focus on. So retailers are many retailers are dependent on debt on their local bankers, not so much the national credit agencies or the major lenders, but on SBA loans and commercial bank loans. And some of them were able to get some of the money from the Paycheck Protection Program. Some folks successfully applied for EIDL loans, the economic impact, economic injury disaster loans. The Main Street lending program really worked out for many of them because the legislation didn't really address the fact that the commercial banks still have to apply regular commercial criteria to the loans that come in front of them, and a lot of retailers therefore didn't qualify because they are kind of by definition, and the reason they were going there was they were somewhat distressed. But how do you think, Matt, that lenders are going to look at retailers, and what kind of borrowing options are likely to be available going forward to retailers specifically?
Yeah, and I'm a former bank stock analyst, so I can kind of put that hat on and how I think banks typically look at this. I mean, banks have become much more risk model driven and much more model oriented. They've kind of had to become that way because of the annual stress test that the Federal Reserve is putting them under. And I think, a lot of the stress scenarios was always let's look at past environments and how did that loan hold up? In particular, how did that business hold up? And that the stress was over the last decade has always been, how did this business do during the great financial crisis? I think now there's going to be another stress scenario going forward of how did this business hold up, and how did the cash flows hold up in March and April of 2020? And I think the challenge is that's obviously an extreme, arguably once in 100-year pandemic kind of environment, but I think that's going to be looked at. So I think as you look in the post-COVID era, I do think lenders are going to be paying attention to kind of a left tail event or an extreme event of how can this business still stay afloat in a March or April of 2020 type of environment. I think the positive is there is a lot of capital out there for lending. It is slowly migrating away from banks and migrating more towards non-bank lenders. There's a lot of private debt firms out there that are making loans, but that tends to be at kind of the 10 million in EBITDA level and up. So I think below 10 million in EBITDA really is kind of the bank's sweet spot, and that's where they're at. I think each bank is going to be a little bit different. And one of the things I learned from my past is that credit decision varies by bank. If you're at a large bank, often those credit decisions are made at the corporate level. As you get down to smaller banks, that credit decision can be made at more of a local or regional level. It could be at the state level, or it could be even at that local bank branch. And so I think if you're a smaller independent retailer, as you're partnering with banks, understanding where that credit decision is made can make a difference, because the local banker, if they have the ability to make that loan, they may understand how important your business is and how it may thrive in the local community. Whereas that, as you get further away and that decision is made more nationally, that impact might be a little bit lost.
Great, that's really helpful, and I think that also speaks to, just because you get turned down by one bank doesn't mean that the next bank you go to will also turn you down. And so you don't give up because you get no from one, if you do need those funds. Jared, anything you'd like sort of how the debt markets and lenders will be looking at retailers in the future?
Yeah, I mean, actually, Chair Powell was asked about Main Street Lending Program at the last press conference, and he kind of acknowledged this issue of it's not working to the extent they want it to work. And so I wouldn't be surprised if they made changes to Main Street Lending and to make it easier or somehow address this issue that there's not as much take up as they expected. So there could be changes there. Again, it's being run through the banking system, so there's also this intermediary that they can't control in a lot of ways. But there could be changes. The other thing I would just say is that, from as I think kind of the politics ahead, both parties, left or right, I think see the value of community blue collar work, and this idea that lower middle income cohorts have probably not been keeping up with the broader economy over the last decade or even longer. And so kind of community banks and retailers and everything that goes in with those kind of under that umbrella seems to me an area of support, and whether you're left or right. And so as we get to 2020, I wonder if you could see a more deliberate addressing by Congress and the president to recover from the pandemic via stronger and more deliberate lending to these areas.
That would be super welcome for sure. So let's move on to talk about risk. So one of the things that we at Management One are always telling our clients is that risk is inherent to retail, and taking the right risks at the right time with the right amount of information and the right levers to pull in case things go wrong is critical. You can't not take risk as a retailer. You're always taking risk on inventory. But how should retailers be thinking about risk today, do you think? Matt, what's your perception of what retailers should be thinking about in terms of risk going forward, and how aggressively should they be betting versus holding back?
Yeah, it's a good question. I think being positioned to kind of wait for the sweet spot and wait for the opportunities, but then I guess pounce when you get those. And I guess two examples of that could be on real estate. I think, and we can talk more about this as well, but on the real estate side, I think it's not just a short-term challenge on real estate. I think the real estate market for retail, it's going to take several years to kind of play out. And so if you're looking to, whether it's change your location or expand locations, I think having an eye on, either 2 or 3 or 4 locations you'd ideally like to have, and being ready to act if those locations come available is one option. I think the other is just on the supply chain of things. One of the things we keep saying to our clients is the virus is going to kind of dictate things until we have a vaccine. And so on the supply chain side, if you have the ability to finance inventory and acquire inventory, it's not a bad thing to have a little excess inventory from a risk management standpoint, just because you don't know what could happen to that supply chain if the virus heats up in a particular region or the like.
Excellent. All right, good. Jared, what are your thoughts about risk?
Yeah, I think the supply chain point a good one. You know, what we have learned, I think, whether it's through globalization or the pandemic, is that redundancy, as it happens in nature, is also helpful for business, and to have a second supplier, a second source, is probably more vital because you just don't know. You just don't know when these shocks, where they come from, when they come from, and it's just good to have another go-to source to have in the back pocket. The other thing I would just say on the risk side is to point out just you know, some of the obvious winners and losers are those that have kind of invested in automation, invested in technological capabilities. And I guess I don't want to be too pessimistic about the longer term, because I am generally optimistic. But I think some of the winners in some of these sectors are going to be those that do it quickly and early. And at least we see this from the history of technological change. And I did my dissertation in this, so this is kind of a area close to my heart. But you know, those that adapt quickly, are flexible, and are able to implement these technological changes, whether it's inventory management or kind of systems or you know, kiosks at stores, what have you, tend to kind of survive and thrive after the initial shock. And so as we think about those risks, even though it feels painful now, I think in the end, in 2025, you'll be glad you did it.
I think that brings up a good point, right? Which is that there's risk in not investing. You know, there's people sort of tend to focus on the risks of investing. What gets lost sometimes is the risk of not investing, which your technology example kind of points out. So moving sort of on to sort of how retailers should be focusing and how they should be thinking about managing their businesses. One of the things we said is that, you know, you shouldn't throw away your 12-month plan for your store, but you should focus much more intently than ever before on probably the next quarter. So we've, you know, encouraged our retailers. We've actually developed a tool to focus on their cash flow and their business over a rolling 12-week period, and largely driven by uncertainty. What's your sense, Jared, on like sort of how maybe the current conditions should affect people's thinking about timeframes of decision making?
Yeah, I think I like the idea because what we've seen, I don't know if this was intentional on your part, but what we've seen from the virus is that the waves are kind of in these 3-month increments. And so, you know, you get the pattern is, you know, we lock down, we suppress the infection rate, the R naught that people talk about, below 1. We kind of patted ourselves on the back, and then we all started going out and incrementally doing more things socially, whether it's restaurants or going to bars. And then we see the infection rates go up, then we lock down again. And so we're going to be in this pattern, for better or worse, until we have, 50% of the population in the United States vaccinated. And while the amplitude of that wave might be smaller into 2021, just because we're wearing face masks, we've kind of learned our lessons, the wave is still going to be there. And so this 12-week kind of cash flow analysis seems to make sense to me. And I think it totally comports with what we're seeing from the viral data side. And also just remembering that this is the pattern that we'll be in for a while, unfortunately, until we get a vaccination that is more durable across the economy. But we're going to be doing this for a prolonged period, and kind of survival is the most important. But I think we can also thrive in this environment if we're kind of smart about it.
Yep, that makes sense. All right, well, in the interest, I'm going to sort of keep moving along, as I think we're a little bit behind on time. But so Matt, I'll start this one off with you. What's your sense about how COVID-19 might be changing pricing power for retailers? You know, we said sort of early on in the pandemic, and you referenced this earlier, Jared, you know, given, I think you did too, Matt, given the issues with supply chains and potential shortages of inventory, we urged our customers to be really careful and thoughtful before marking down or discounting their goods. And then you're seeing other sectors, where demand is just booming, right? Outdoor, you referenced that, Matt. But is there any overall perspectives on what COVID-19 is doing to pricing power for retailers, or if anything at all, bigger picture?
Yeah, I think you kind of hit on it, Mike. I think it really depends on what segment of retail you're in. If, apparel sales are negative, I think there it's maybe going to be more challenged to hold pricing power versus if you're selling bikes. I mean, right now, at least in the Chicago area where I live, you can't buy a bike if you wanted one. And to your point, if you have the supply chain, you can command pricing power. And so I think that pricing power comment will really depend on where you're at in the retail industry and even how that trends evolve as the virus continues to evolve and as we go into a new season.
Got it. Okay. Yep. Jared, what's your perspective?
This is, I think, one of the biggest questions and uncertainties going forward, this idea of pricing power, because I could see, like you pointed out earlier, pricing power of a high-powered suit not exactly going to be the same as it was back in 2019. But for tennis shoes and those type of things, yeah, I could totally see that changing. So I guess I would overlay if we overlay the COVID framework on top of where we are right now. It would, if we kind of agree that, look, this is going to be probably more prolonged than we think, we're going to be in this environment for quite a while, then maybe these behavioral changes that we think from March to July were temporary. Maybe these behavioral changes are actually semi-permanent, and some of the things, kind of casual leisure and things that we thought would be just kind of a flash in the pan, actually end up being much more important. And when we go back to work, the working environment will also be very different. And I wonder if we have kind of crossover pandemic-related differences in terms of what we wear at work, also just from an apparel point of view, but also just from a general retail point of view. Those behavioral changes look like they're stickier than we thought back in April and May.
Yeah, that certainly is looking that way. So let's go back for a minute to supply chain. So we've talked about kind of the near-term effects of issues in the supply chain, and obviously we had a lot of disruption in the first part of the year. What's your perspective for how supply chains recover and evolve, kind of both in the near term and longer term? Jared, what's your view on how that might change?
Yeah, so on the kind of China supply chain, kind of U.S.-China supply chain, I don't think, regardless of administration or who wins the White House here, even if it does go blue, or whether it's a blue wave or whether it's kind of a purple wave, whatever the wave is, I don't think these kind of this relationship with China is going to change materially between the U.S. Where I could see kind of changes is more along our allies, a better relationship with our allies, maybe a little more multilateralism, but nothing like we had seen prior to the crisis. And so I guess from a supply chain point of view, I could kind of see changing. So we're not going to eliminate China, but we're going to move from China being a low price supplier, which, it kind of had already started fading a little bit to Vietnam and let's say Indonesia, which are allies, right? And so I think we're just going to kind of shift these supply chains. I think it's going to be hard generally. It really depends on the margin and the product to bring everything back to the U.S. And even if we did, I think it would be kind of a labor light type reshoring. But I could see it kind of coming into Mexico, coming into Canada, and kind of nearer supply chains with allies that are kind of along the lines of where the U.S. stands.
Okay, Matt, what's your perspective on how supply chains might evolve?
Yeah, I think just to echo kind of on Jared's points a little bit, I think the supply chain process had started to evolve really a couple years ago once the trade negotiations started with China, and more companies started to look to at least be dual sourcing, starting to maybe have some more localized manufacturing, whether that be in Mexico or something that was a little bit closer. And I think to a point that Jared made earlier, I think all that COVID is really doing is kind of putting the exclamation point on it of really dual sourcing, or even having 3 different sources, not just for manufacturing, but even have geography. So if you do source from a location that ends up getting caught in a COVID epidemic, you could then get, or a COVID wave, you could then go to a different geography and source your product there.
Makes sense. So beyond merchandise, after merchandise, which is 50 or 60% of revenue for most retailers, the next biggest expense is often, aside from staff, is often real estate, rent. We have a lot of things going on in the real estate market. We have retailers asking for rent relief from their landlords. We have landlords in some cases providing relief, in other cases holding the line, in other cases would like to give relief, but their own sort of mortgage covenants, mortgage conditions prevent them from. And then we've already seen some of our customers actually taking advantage of lower prices, of lower sort of demand for rental space, and opening up new locations or looking at new locations. How should retailers be thinking about space? So Jared, I'll let you sort of start this one off.
Yeah, this is another big question, and kind of goes back to the behavioral changes. Not only space, but like what does the experience look like post-pandemic? And I think some of this stickiness of behavior that we're used to kind of ordering online, and that's going to stick. And then maybe we expect a very different experience when we go into the store. Maybe it's something that's more customized, that they have your profile, they know what you bought, and they become kind of more, I guess, kind of up the value chain than what we saw back, pre-pandemic in February and March. So I guess I overlay that thought with what does that mean for the store or kind of the real estate footprint. And I think it does mean a very different footprint than what we had before. And so I'm kind of totally spitballing a little bit and kind of big picture, but I'm not sure what it looks like. I think it does look different, and I'm not sure if it means you need a smaller footprint or a bigger footprint, or do you need to collaborate with different kind of co-ops or kind of have a multi-retail experience. I don't know exactly what it looks like, but I will say that, post 9/11, folks thought deurbanization and kind of New York was going to collapse, and no one ever want to live in the city. It only took 2 years post 9/11 for airlines to get back to the level they were pre 9/11. And so while we kind of fret and say things will never return to normal, there is resiliency not only on the consumer side, but on the producer side, I think. And kind of going back to earlier points, I think folks who kind of make those adjustments quicker and earlier will reap benefits. But I'm just not in the camp that this will lead to like New York City population going -5% over the next 10 years.
Got it. Matt, what's your perspective on how retailers should be thinking about real estate looking forward?
Yeah, I think COVID's going to create some leverage for retailers, but again, it kind of goes back to my earlier point: is it may take time to play out, and you kind of have to pick your spots. So if you think, and to be candid with you, I would have thought 6 months ago, I'd have thought by now we'd have seen a lot more dislocation in commercial real estate than we've seen. We haven't seen it yet, but it's coming. If you look back to April, I was talking to a real estate firm that we invest with, and they do some retail real estate. And in April, 57% of their tenants paid their rent. By July, that number was 66%, and in August, the number's like about 73%. And if you look at kind of typical economics for kind of a retail commercial real estate property, 50 to 60% of their revenues go towards just general operating overhead costs and basic maintenance. And then, every property is different in terms of how much leverage they have on it, but it probably averages about 20% of revenues then goes towards interest payments. So you're kind of looking at about 3/4 of your revenue go to kind of the basic things you have to pay just to own the property. And so when you're getting vacancies rising, or you're getting tenants that aren't paying their rent, you're all of a sudden pretty quickly looking at negative cash flow scenarios. And borrowers each borrower is going to be different. They may be able to withstand that for a period of time, but ultimately it's gonna come to roost. And I think that's going to slowly happen a little bit over time. And so I think for retailers that can be patient and say, this is a location I'm going to hold out for, these are 3 or 4 locations that I'd love to have. If 1 or 2 of those becomes available, I may move my location or may open another location. I think that has an opportunity, that they'll have an opportunity there. The other thing that is going on, and I don't know enough of the details, and Mike, you may even have a better sense too, is there are some larger retailers that are kind of holding out, and they're choosing not to pay rent, and they're choosing it as a bargaining chip. A lot of the smaller retailers, right, you don't have that as a bargaining chip, but if you can work with larger landlords that might own a number of different properties, and you have a lease with them, you can hold out and say, hey, I know conditions are softer, I want to renegotiate terms. And I think there is a bit of that going on. I think once that happens at some of the larger retail levels, I think that's an opportunity for smaller retailers to go back and say, hey, wait a second, you cut these guys a concession, let's talk about a little bit lower rent per square foot, especially if there could become more vacancies available, you at least have a lot more bargaining power. So I think there is going to be a shift in the commercial real estate landscape, where those with leases are going to have much more bargaining power than they might have had the last 5 or 10 years.
Yeah, I mean, I think that we've definitely seen that among the larger retailers, right? I mean, Gap and Nordstrom notably have started to deploy some of that leverage. All right, well, let's move on to, we've talked a little bit about this. Jared, you've talked about this already. This is one of your sort of areas of specialization of technology, right, and how it affects economies and behaviors. We've talked about some of this, but how do you see technology affecting retail now, kind of what's going on in the near term, and kind of how COVID maybe has changed the trajectory of adoption of technology in retail? I mean, we've certainly seen among our customer base, they have, the number of stores who have activated or invested in e-commerce and social media selling over a very remarkably quick period of time has been impressive. But where do you see things going in terms of retail technology?
Yeah, I think frankly, we're in the early innings of, if you look from the economic point of view, which I do on the kind of productivity side, one of the least productive industries is construction, and retail is not far behind, just from an aggregate point of view. And so I wonder if this is going to accelerate that automation that probably should have happened already, and this is just kind of the stimulus or the catalyst to get it going in a more forceful way. So I definitely see like this picture here is showing what we've seen from kind of AI, but let's call it machine learning and kind of big data. Those combination of I guess skills and bringing them to retail, I think will draw dividends. The bad thing is that that probably means a lighter labor model than we're used to, or at least a changing labor model. Kind of going back to, do we become more higher end, or not higher end, but more customized? So when folks come in, they have a kind of more customized experience than they did before. But I definitely think on the back end, just knowing kind of sourcing of data, using data to source different inputs, understanding the pricing trends, understanding your customer so you can hyper customize and segment your customers more quickly. I think that's all going to be trends that we see in retail, and beneficial for everyone, I think.
Yeah. Matt, what are your thoughts about technology and how it's going to affect retail?
I don't have a whole lot to add beyond what Jared said. I think he's clearly got a strength there and strong background.
Yeah. Yeah, I mean, I think, Jared, that makes a ton of sense. I mean, obviously, it doesn't seem like the share gains that e-commerce has accelerated, right? E-commerce had already been gaining market share before the COVID crisis. That's clearly accelerated. That doesn't seem like it's likely to go backwards. Seems really very little chance of that. But sort of maybe that segues into sort of our last sort of question, last slide before we open it up to questions from the audience is, long-term effects, right? So I think, Jared, you've talked about this a bit already, is, some of the changes that we've seen during this COVID pandemic and the associated sort of economic and activity changes may persist, and some of them may not, right? How are you thinking about that? What are the things you think are going to persist the most in the ways that people have reorganized their lives?
It's one of these things that there's going to be a lot of change and there's not going to be a lot of change, and I wonder. I went to a restaurant last week with my wife, and kind of pre and post pandemic, so we were able to compare what it looked like. And post pandemic, you're able to look at the menu on your phone, you're able to pay on your phone, and so I don't know if that's gonna change per se, that type of experience post pandemic, and maybe this is a permanent thing. What I do think will change is kind of other things I think will change will be kind of our, I guess, kind of interaction with each other. I don't think, we're going to be more, I think, careful post-pandemic with our distance. There's going to be scars from the recession that are persistent. There might be higher savings levels by consumers, so they're not going to be quick and eager to kind of get back to higher luxury goods and that type of thing. And so I do think there's going to be kind of going back to earlier points of kind of lower wages and still levered consumer. So I think that kind of cautiousness might persist with kind of areas of punctuated exuberance, whether it's in kind of millennials or even older income cohorts that say, hey, the pandemic showed us that life is short and we need to do what we need to do as early as possible.
Yeah. Interesting, Matt. What's your perspective? I mean, one of the things that I think about is to what extent are we going back to the office, right? I live in New York City, and obviously, the Midtown Manhattan, which is not far from where I live, is it's kind of a ghost town these days. And the big question everybody is asking here in New York is, are people going to come back into those office towers? And if they don't, what is that? What are all the knock-on effects of that? What's your perspective?
Yeah, I'm less convinced of the persistency of that. I kind of agree with you in the near term, Mike, on that. I think if I look at our firm, I think it'll be a gradual increase in people coming to the office, and there'll be a lot of people that don't go to the office 5 days a week. I kind of think back to 9/11 and remember flying in November, December of that year, and I was one of 20 people on the plane, and 3 or 4 years. The next year it was, you could be pretty much guaranteed you wouldn't have somebody in a middle seat. And 3 or 4 years later, the plane was packed and you were kind of wishing and longing for those days when you at least had that middle seat open. And I think you'll kind of continue to see that. I think, we've all proven we can be productive at home. But I think as time goes on, that novelty may wear off, and you may find you are more productive at the office, or the collaboration is there, or there's just less, I guess, trust as time goes on in people that are working from home as much. That's my personal view. I guess time will tell. But to add on to what Jared said earlier, I think the other thing that the COVID's brought on is a lot of the shift going on in the retail industry, I think, was just accelerated with COVID. I remember 8 years ago for the first time hearing the word omni-channel and not fully understanding what it is. And I think it's been hammered home to me over the past 6 months of, whether that's, having it delivered to your house, waiting outside the store and picking it up, or actually going in and shopping in the aisle. I think that's a lot of what we're seeing in terms of how the positive effects of COVID and changing the environment is it really is pushing forward a lot of that technological adoption and letting people figure out really what they're comfortable with, what's their preferred method to get their goods.
Excellent. Yep. Jared, you said something to me last week that stuck with me, which was that people flew on airplanes regularly pre 9/11, and relatively quickly they were again flying in airplanes post 9/11. But your experience of going through the airport and getting on the plane was altered permanently. So that's maybe something to sort of think about for our customers, right? Is that people are still going to shop, but you're going to need to adapt the way that you serve your customers, maybe on a more permanent basis than you might have thought at the beginning of this pandemic. All right, so I'm going to open it up to questions now. Nico, do we have some questions from the audience? And I apologize for the timing here. We're a little bit close to the end of the hour, but we have time for a few questions, hopefully.
Thank you, Mike. Yeah, we actually do have a few. We had a lot of comments when we were talking about Washington. A lot of folks really latching onto the PPP loan. So I'll start in that sector. There's two questions that are virtually the same, so I'll combine them. So some of them saying, if a second stimulus does not come, how likely is it that payment terms could be restructured in these first round of loans? And then the second part of that is there any changes happening in the Main Street lending program?
I guess I can start. I'm not aware of any changes happening in the Main Street lending program. I know that was a challenging program just even to get off the ground. I think the Fed was delayed considerably just in launching that. So per Jared's comment, it wouldn't surprise me if the Fed's starting to knock around potentially changing that, but I have not heard anything on that. In terms of adjusting the payment terms on the PPP loans, I mean, I think that ultimately falls to the Treasury Department on that. And that's, I guess, a good question. That may be dependent on who's the administration and who's in the chair as Treasury Secretary, come late January of next year.
Okay. My only addition would be to say I think everything is in play, and I would say the more the lobby of retail can get to the administration, I think they're open to anything being on the table, and whether it's kind of payment terms or whatnot, or expanding the program or doing another program. I do think the administration and future administrations too want to support the economy. I mean, that fundamentally, and they'll do things that might have seemed crazy before, but look, post GFC, we never thought the Fed was gonna, or pre GFC, we never thought the Fed was gonna buy trillions and trillions of bonds and MBS.
Yep.
Excellent. This next question is for Matt. For available capital that we do have in the local banks, should we shift this to another financial entity that would yield more return, or is it really safer to maintain liquidity?
But I guess it depends on your liquidity needs and how much liquidity you have. It's hard to find more rates at this point in time. I mean, if you look at the Treasury yield curve, which is what we look at on the bond market, for where you're getting yields, you're not really getting much yield pickup as far out as 5 years. And so, yes, you could shift it and pick up 5 or 10 basis points more, or call it 0.1% more. But I don't think you're getting a whole lot by shifting the money out of banks to someplace else, unless you really wanted to take more risk and have a risk that some sort of you can buy corporate bonds and take a little bit of risk that corporate bond could default. But I think we kind of look at it from cash perspective. Rates are pretty low across the board.
Yeah. Yeah, for sure.
I have a question actually for, this one's probably more for Mike. One of our clients is saying that in their store, clothing sales are down 50%, but gifts, drinks, hard lines are pretty steady. And is that something that you're seeing pretty much across the board in the US?
So I would say there are regional variations in the US, region by region, in the data we're seeing. But that general observation of hard lines doing better than apparel is true. When you peer into apparel, though, it does depend what kind of apparel we're talking about. Yeah. People are, the sort of active wear, sort of loungewear, sort of good-looking casual, things, comfort clothes. Those things are doing fine. but of course, you know, when you also have some things on the other end of the spectrum that are just killing it, right? So crafts, any sort of outdoor oriented hard goods have been doing great. And you know, as you know, Jared and Matt noted, like you can't get a bicycle for love and money in some for love or money in some parts of the country. So, but yeah, generally speaking, apparel has been more challenged than some of the other hard goods categories. Garden and home has been doing great. I mean, people are, you know, it's the summer months, but you know, garden is, you know, up 15%, 20% over last year. Home, you know, people are spending more time in their homes. They're investing and spending on the comfort of their experience at home. So that certainly seems to be true.
Excellent. And final question might be a little bit out of the scope for the panel, but I wanted to address it anyways because of the discussion between big box versus independent retailers and how this is impacting them differently. Neil is asking, address the move by Amazon to luxury and how that could impact our clients, because that was an interesting third-party move by Amazon.
Yeah, that is interesting. So, Jared or Matt, I'll let you chime in a minute, but I guess, you know, Amazon has made several different forays into the luxury fashion market. They started with My Habit, you know, Amazon Fashion. They hired a woman named Christine Beauchamp about 3-4 years ago to try to juice up their fashion. And when I say fashion, I mean fashion. I don't mean, you know, Amazon is doing great in lower end apparel, but in higher end luxury apparel, they're really not. So, you know, look, Amazon has infinite financial resources and has lots of smart people that haven't yet overcome the sort of the image issue that a lot of consumers and brands in luxury have had. So it really depends on getting the brands to play ball. I don't know, Jared, Matt, do you have any other perspectives?
I would just say, you know, looking at Amazon more holistically, they've kind of have this model of trying to throw noodles against the wall and see what sticks. So I know they've tried to get into auto parts supply, and they've tried to get into medical supply distribution. And last I've kind of seen, they really didn't have a whole ton of success in it. So it doesn't surprise me they're trying to, you know, see if they can get into another market. And, you know, they got a ton of cash that they can throw at the problem and see if it works.
Yeah, I just agree there. We have some folks from Amazon here at Capital, and they are very willing to just take a hard look at different businesses that aren't within their wheelhouse, just to give it a try. And look, like we pointed out earlier, commercial real estate prices are probably going down, so maybe they can pick up some cheap real estate that will be helpful for them.
I think those are all good perspectives. I mean, Amazon has successfully gotten into new businesses. They've struggled in luxury fashion, but they're clearly not giving up on it. And this is their latest play. And so I think if you're in luxury fashion retail, you have to keep an eye on them for sure.
Excellent. Well, we are about 5 minutes over time here, so I think I will close it there. We had a couple of questions that can be answered independently offline, just not quite related to finance. So I will leave it to Mike to close things out. I wanted to thank the panel and retailers personally myself here.
Excellent. Well, Jared and Matt, thank you for your participation. Thanks for what I hope was an interesting conversation for our audience. I certainly enjoyed it. And thanks to our audience for listening, and enjoy the rest of the day. Thanks very much, and bye.
Thanks.